Good day, everybody. Welcome to today's edition of the Eye of the Storm podcast. Today, Dan Ascani and I are going to be presenting the topic of the moment, let's say, and that is the Silicon Valley Bank failure, the speed at which it occurred, and the fallout, which is now just beginning to roll out and become apparent as we're seeing different sectors and we're seeing different areas of banking and different companies that were dependent on their deposits with Silicon Valley Bank, et cetera, et cetera. So essentially what we're attempting to do today is to have an Eye of the Storm podcast, which will include some factors within a big picture update, but more importantly, it's Dan and I attempting to get behind the curtain to reveal what we feel and what we see is actually happening and has been in the making of occurring for longer than people imagine. And that maybe that avalanche that's coming down the hill is basically just beginning and picking up speed. And so we're already seeing it start to take out its victims as it rolls towards the main town, let's say. So again, Dan, welcome so much for joining me today. Again, I know that I personally enjoy our talks. I enjoy the time that we spend together. And so the other way that I wanted to do this today, folks, both Dan and I agreed actually, is to present it more in a conversation. And as we get into that conversation, we'll be pulling in facts, other pieces of news as they become pertinent to what we're having to be talking about at that time. So let us begin. So again, welcome, Dan. Thank you so much for joining me today.
The big and thank you for having me again.
Yes. First, I should say, just to make sure people understand, it's not that we only talk once a week. We are talking every day and sometimes at great length. Because of what's happening, because of the markets, and because of what we do and what we love. Now, we're both Elliott Wave analysts, but we're also just analysts, economic analysts. We're just taking a look at things and how they all come together and how they all fit. And I'm going to say what makes us different than many others is because our depth goes back so far. We have lived through the crash of '87. We have lived through all the mini crashes up until 2008, 2009. And we lived through that phase. We understand a lot about inflation and where it comes from. We've discussed that here, where we talked about gold in a deflationary economy, and how the different sectors that we all, or asset classes that we all attempt to get into, are affected. Now, one of the things that I will want to discuss today is the seriousness of this situation as it begins to unfold and we're getting more and more data. So let's just put it mildly to say that I was not necessarily stunned, but I guess I was in a way, that Silicon Valley Bank, which I believe maybe a year and a half ago, reached a high of $795 a share. And actually on Wednesday, I believe it was, traded and closed the day at close to $300 a share. But by Friday midday was shut down by the state regulators here in the state of California, but also the FDIC stepping in, taking them over. So this whole process, this whole massive decline took 48 hours. This is what I was like, wow. This is not even, we're going to give this an opportunity to find their footing. We're not even going to give them an opportunity to get any money, et cetera, go seek additional financing. They walked in and shut them down, folks. And now we're beginning to see the different other areas where it's having an already effect. So leaving that all in, I'm stunned. I don't think people really are looking at the seriousness of this situation. So that's kind of where I'm beginning our conversation.
Yeah, and first of all, thank you for having me again, Michael. I enjoy it a lot too. And I got to say, though, I don't know if we're in the eye of the storm anymore. I think that the back wall of the hurricane is starting to hit. And I don't want to sound doomsayish, but hey, that's the reality we're in right now. There is a lot of things happening. So you're right. So right now people are scared and, calmly scared, but you have institutions who at the present time are worried about how might I meet payroll, for example. Some of them were counting on the funds they had on deposit at Silicon Valley Bank, which, as you said, collapsed in the FDIC receivership. And while those who are qualified for FDIC insurance are assured by the FDIC they're going to have access to their money on Monday, I'm not so sure everyone else is. So you probably have a lot of meetings going on between executives and investment committees over the weekend trying to figure out what to do. And I'd like to, as we talk about this, I'd like to also pull people back into the big picture, because there's something bigger than Silicon Valley Bank happening and bigger than the banking system. And the reason I say that is right now everyone's going, okay, so maybe this isn't systemic to the banking system, right? The banking system's strong, so it's not a systemic problem. But as I'm covering in one of my reports that I am just getting ready to finish up, this is a systemic problem to the entire financial system, not just Silicon Valley Bank, but what's going on and the causes of this are systemic, and they've been made that way. And I think that'll be a little clearer as we go through this conversation, Michael. I just threw a lot at people right there, and a lot of it's pretty generic, but we'll get more specific as we go.
We will, and thank you. I appreciate that. I think that one of the things that I'm really looking at here is exactly what you were talking about. What really caused this, and where can we look to see what happened? And as I started to look inside what was going on at Silicon Valley Bank, and I had initially heard, and I cannot believe that people say, oh, it's not anything you really get too worried about. They just got stuck in some treasury investments that they weren't able to get out of because they weren't allowed. They were the type of investment you're buying it for the term. You're buying it for the term of the bond. And suddenly they needed the money. And this is something, if you go ahead and add whatever you need to add right there, because this is my understanding. And it may have been a part of the carry trade. I don't know. But when I saw that, and then they started to run into people like, I'm just going to say it, Peter Thiel coming out and saying, take your money out, just get out of the bank. Which then, of course, didn't happen because the first thing they did is tried to hit the stock.
Well, yeah, so you're right about the treasuries. I think what happened was a bank has to have assets. So they have all these investments as they receive deposits over the, I'm going to say the years, at least the last few years, they've put it in treasuries, treasury bonds issued by the government, treasury notes, and whatever term they chose. But what happened was, as everyone knows, the Federal Reserve last year, about a year ago, started to raise interest rates, and they raised them at a record rate. And that the treasury bond market, I think, on record. I think you got to go back to the beginning of data on it, and it's steeper than any decline we've had in any one year period. So what that does is, since bond prices go down when interest rates rise, you've got a bank like Silicon Valley Bank, as I understand it, with a lot of their investments in treasuries, but during a rising interest rate environment. So the value of those bonds that they were holding were going down, down. And so then they started to get into it. And I think they were advised by the investment advisor firm that they retained for consulting on this, that in order to do a stock issuance to help raise cash so they could operate, they'd have to mark those to the market or sell them. I take that back. They're marking them to the market anyway, but they have to sell that portfolio at a loss. And the question is, why did they announce that before they issued the stock? So when they came out and said it all collapsed. And that wasn't necessarily the cause. That's not a timeline that I just went over, but you're right. So the fact that Treasury prices went down during the year caused losses in their investment portfolio. And I heard they're huge because they were going to sell the portfolio. So that is, as you mentioned, part of the other side of the carry trade. I'm going to throw more terms in here that are a little bit complex. We're going to try to make, and I said, I think in the beginning, let's go pull ourselves way back to the big picture. So people right now are looking at, is this systemic to the banking system?
Right.
They may conclude, well, the banking system is pretty strong, so I don't think the money center banks are going to have a problem here. They may conclude that, but what's really in the bigger picture is why all of this is happening. Why, for example, is the crypto industry collapsing? Why did Silicon Valley Bank collapse and Silvergate Bank? And why are there some hedge funds that close their doors because the trade that they were featuring is no longer working? Again, oversimplifying that. But the reason I say the carry trade is because of something that's been going on in this country for a few decades.
Right.
Go over that in this report that I'm writing, and I'll make it available on defendingyourmoney.com when it's ready, hopefully soon. But we go over the explanation of that. And I'm trying to figure out right now as I'm talking where to start because it's a complex subject. But in a nutshell, the carry trade is when you cheap and invest in something that's going to give you higher returns than the cost of borrowing. The difference between the two is the carry. So that's commonly known in where people might sell the yen, for example, and that's borrowing in yen or borrowing from the yen, and then invest in another currency, the assets of a country that has another currency, and capture the difference. There's a carry. That's foreign exchange, a butchered definition of it. But what's really broadened out over the years since the crash of '87, and I go over this in the report. Some of you may remember the plunge protection team that Ronald Reagan started by executive order in 1988, and that is still functioning. Now, that's a colloquialism for the name they use now for it, but it is chaired by the Treasury Secretary, the Chairman of the Federal Reserve, the Chair of the SEC, the CFTC, and possibly some others, but you've got the heart of our financial system governance in there. And the reason I go over this is because the government learned when they formed the plunge protection team after the '87 crash that we may be able to influence the markets or, prop them up or keep them from crashing, which I think is what Ronald Reagan's goal was at the time. Because I remember him on TV in the '87 crash saying, there's nothing wrong with the economy. And there really wasn't at the time. It was a market crash. Why did it happen? It's the carry crash. We're going over that right now. So he wanted to form a way to keep that from happening, keep the markets from crashing. So again, the plunge protection team was formed. But then fast forward to the Asian contagion crisis, the Asian flu, as they called it, that went on from '97 through '98. And in there, we also had the Russian debt default in 1998. But fast forwarding to there, when Asian contagion occurred, it was going from one Asian country to another. Investors were pulling money out of those countries in droves. When that occurred, the Federal Reserve suddenly, in a surprise move one day between meetings, did a massive monetary easing. And in fact, they did 3 large unexpected rate cuts between September and November of 1998.
Right.
And that is the point that marks the Federal Reserve's interference, I want to say, there's probably another word for it, in the financial markets. Because what they learned was we can adjust monetary policy by dropping, and that gets people going again with respect to the financial market, and they bid the stock market back up, for example. And that's worked a few times for them. But we're going to go over the issue to this in a minute, the issue about this whole thing in a minute. So the Fed drops rates in 2008 to 9 now to zero interest rate policy, or ZIRP, ZIRP. to zero, and institutions who have access to that free money basically can borrow it or acquire it and then invest in the stock market, and that drove the stock market up for years with mini crashes in between.
Right.
So that's the carry, and I feel like I'm throwing out too much all at once here.
No. I
intervene.
want to add one point in the timeline, which I think is what you're saying is extremely valid. But I remember, because I was actually on the floor, I was trading 97, 98, and then we got those interest rate cuts. And could you not say that was the start of the next carry trade? And it all took place right here in my backyard called Silicon Valley. But it was when the dot-com boom followed. And then what came out of that carry trade was the dot-com bust. So again, we're seeing how good intentions began, but things got out of control without proper whatever. And then what the result was, maybe in line with what we're seeing again today. Different situation, same underlying problem. Is that a fair statement?
Yeah, different situation, same underlying problem, same wizards behind the curtain, which, by the way, when we peek behind the curtain, we see the wizards scrambling right now because they've got some decisions to make, which we'll get into. But you're right, that was a good ad there, Michael. But the thing I wanted to point out, though, is that as this carry trade is put on, it's broadened out so much because the Fed also is the world central bank. You know, other countries' central banks swap with the Fed, so the Fed is really providing liquidity for the Western economy, the world, basically.
Right.
So it's this whole carry situation has broadened out so much that instead of just being a common trade in the foreign exchange markets, it broadened out after the crash of 08 and 9 into the stock market. So that the S&P 500 became a sort of distributor of the carry trade enabled by the Fed. And again, what I mean by carry trade is borrow cheap, invest in something with larger returns than the cost of borrowing the funds, which in the case of the Fed after the crash of 08 is zero or close to it. Borrow cheap, invest, and you keep the difference. So what happened was so many institutions started to do that over the, 10 or 12 or more years since the crash of 08, the stock market went up and up and up. And it became almost a self-fulfilling prophecy. Keep getting that zero interest rate money from the Fed and keep investing in the stock market. It kept pushing it up. And then companies got the idea and started to do stock buybacks. Another symptom of the carry trade, because money was almost free. So they start buying back their own stock. That pushes those stocks up, and it's up, up, and up. And that's how the Fed creates a mania, a bubble, off of the very policy that it used to try to keep the next crash from happening. Or to save the economy from the crash that was underway, 07 to 08. So the other side of that trade, and what we're getting to today with the Silicon Valley Bank situation and the potential implications of all that, is that the other side of the carry trade is when that whole scenario, that carry trade regime reverses. So now the cost of money isn't zero. The Fed has Fed funds at, what are they at, 5%?
Yeah.
Close to 5%. Now, and the stock market traced out a down year in 2022, a bear market, big one. So now you not only have your investments faltering, but you got the cost of money, not zero, but whatever it is that they acquired at, maybe 5%. Let's just use that as a round number for purposes of illustration. So what happens? They want to get out of this trade. They want to get out of the carry trade, and it's not necessarily a voluntary thing, because what happens is the trade's not only not working, but liquidity is being pulled from the system. So the Fed, in doing all this, provided liquidity when it went to a huge easing of monetary policy, the other crashes we just talked about, from very easy money to tight money. Basically, that's a lot of liquidity. They pull the liquidity, and now the markets are faltering because there's less liquidity. And that's very important, because what's happening now, Silicon Valley Bank and whatever is going on forward, because we are still under the fog of war, so to speak. We still don't know the full repercussions of that bank failure, bank failure, they closed it down.
Right.
We still don't know all the repercussions of that yet. We're just getting them now. But the point is liquidity is being pulled from the system, and now everyone wants out of that trade. And when that happens, they all head for the exits at the same time. That's why we get what's called a carry crash. Everyone, institutions and so forth, getting out of the trade at the same time because they have to. They're usually forced out. And that's an oversimplified version of it, Michael. I'm sure you know, being in the industry for so long like me, it's an oversimplified explanation because it also blow the carry trade up every cycle. One of them is volatility, the VIX and so forth, the VIX being a measure of volatility. Another complex aspect of this, but let's just say that the carry trade enabled by the Fed, which became global and wasn't just foreign exchange, it was stocks. The carry trade enabled by the Fed provided liquidity, and it's a volatility suppressor. And there's reasons for that. Again, this is almost industry jargon, but just know if you're listening to this or watching this, that the whole thing that the Fed does when it tries to save the economy from a crash and it goes to zero interest rate policy and quantitative easing and all that stuff, it's a suppression of volatility. So the markets start to go up, they become less volatile, which sounds like what we want, except for one problem, a huge problem. Repeatedly, over and over, every cycle, the bubble that's created by the zero interest rate policy and the creation or enablement of the carry trade, the bubble that's created, the mania, bursts. Everyone heads for the exits, volatility spikes and blows up those institutions involved in selling volatility. Those who remember Volmageddon in February 2018 will know what I mean. Mm-hmm. And, if we got a volatility spike now, there's so much volatility selling that's been going on, we might have Volmageddon 2.0.
Or 3.0. We're not sure. We may have already
2
had
and 3.
Yeah, we may already, or 2.3, exactly. It's like there's so many layers that we need to get through. But thank you. I don't think it was oversimplified. I think we need to present it in a fashion where people that are coming in and trading, people that are coming into the markets, people that are looking and trying to determine what can happen. Well, there's a whole lot that needs to go into that conversation and into that equation before you can realize where you're going to want to trade and how you're going to want to trade. But with respect to that, I have found that when you are a day trader and you're coming in and you're moving each and every day with the market and not necessarily carrying a position overnight, it puts you in my estimation, a position of luxury, because you take on an attitude where you don't care what's going to happen. We're just going to be following what the market is actually telling us, what the price action is telling us, and hopefully catching some of those moves. Now, I don't want to sound smug or even bad on that note, because I know there are many, many people that are subscribing to my work, subscribing to your work, but what they're really looking for is, it's like, well, tell me what do you think is going to happen in 3 months? What do you think how's all this going to play out? And that's where I think you're giving that background. And I think because we've gotten such a short term in nature, excuse me, that our whole perspective is on Monday, or our perspective turns into what we now heard from the news. Well, the markets are waiting for the CPI number on Tuesday before they'll decide as to whether the Fed will raise 25 basis points or 50 basis points. And I'm like, boy, do they have you on the other side of this curtain with zero understanding of reality.
And that's going to make the Fed look really bad when it raises into this problem that we have right now. Even the Fed may not realize it yet, or do they? We don't know.
Well, so could the surprise not be, oh, we're only going to get 25 basis points? That the surprise could be you're getting 75 or a full point. Now, I'm not saying that that's what's going to happen, but we've got a Fed that now has to deal with a very, very serious situation that they have to take some responsibility for creating. Now, they're going to try to take some responsibility. Well, we're trying to correct that problem. But yeah, I don't want to go there. That part of the discussion I'll leave for some other time. But I'm really just, my concern is what people are interpreting. And let's go a little bit, talk a little bit big picture. We saw the markets really start to collapse significantly on Thursday. And then we saw a fair amount also on Friday. Both of those days, it ended up being tied to 0 DTE options and gamma. And just to kind of say what gamma represents, folks, is that for every dollar increase in or decrease in the underlying product, it tells you what your delta is going to increase or decrease. And that then forces the trade. If your delta and your gamma is telling you that as the market goes down, you're getting longer, your position is picking up long delta, your only thing you can do to try to hedge, and again, now we'd step outside of that, we can go into, there are hedge funds that have much, much bigger positions than 1 or 2 options contracts. You know, they're gigantic. And again, they're in the 0 DTE. So their position either comes to fruition or dies that day at 4 o'clock Eastern. And we kind of get into this space in our heads where we're not really taking what's truly happening even behind that curtain. So what we saw on Thursday and Friday in terms of the equity markets, if we looked over at the interest rate markets, particularly the 30-year, the 10-year note, the 5, et cetera, all the way down actually to the 2-year note, a massive influx of capital, moving it in, prices went, the bond price soared. And to the untrained eye and mind, to be like, wow, look at that. Fed's going to pivot. Fed's going to cut. They have to cut. We have all these disasters happening. They can't just keep raising rates. It's like, no, don't misunderstand. It's just a great movement of capital because people are looking for safety. And so the safety trade was kind of being put on. Now, whether it can stay there, which in my opinion, it can't. I mean, there is a level, but it fits my own personal Elliott wave count, which I have talked about on my own podcast, on my updates. And there's still a little bit more upside room. But folks, I want to tell you, when it's over and the reality comes back and gives them a good smack, those bonds will drop again. But how they're going to drop is very consistently in the next greater leg down in bond price, up in bond yield. So we continue to look out at that September Fed funds and further to get some inclinations to what do traders, what do market makers and traders feel where interest rates are headed. There is no sign, none whatsoever, that interest rates are going to go down. I'm not receiving anything. And I'm going to even say, even if the CPI comes out like, hallelujah, somehow we're showing that inflation's tamed even more.
So you're talking about Fed-controlled interest rates, because we did lose 50 basis points out of the 2-year yield, I think, on Thursday and Friday. So the market dropped rates on its own, at least for those 2 days. So you're referring to Fed-controlled rates?
Yes.
Right.
Yes.
So usually what happens in these cycles is the Fed gets surprised too by what happened, which is too bad because they're causing a lot of it. Not to blame all this on the Fed, but they're the carry trade enablers. They're the enablers of this by making this free money, quantitative easing. They're interfering with the capital markets, and they think they're doing it in a way that helps. And everyone goes, oh, good, we're not in this Great Depression. It was just a Great Recession instead. And they saved us from a Great Depression. But actually what's happened is they've just thrown it out in time. So
Yes.
maybe there wasn't a Great Depression in 08. They just moved it forward to now. At some point, the piper is going to be paid. So the Fed usually is surprised at this point of the cycle. And is forced to start lowering rates. So you're right. There's no indication yet they're going to lower rates, and everyone's looking for this. Everyone's sick of the word pivot, and the Fed's probably sick of it too. Like, stop looking for us to change our minds and start lowering rates. We're not going to do it. But then a crisis occurs. And if there's a carry crash here, if the stock market collapses here like February, March 2020, or some of the other times, not to mention 08, 09, but if it collapses like that, the Fed's hand is going to be forced. And I think that's one thing the bond market's picking up with that enormous bond price rally Friday.
Understood.
And it actually started before that. Right. So the drop in yields, at least from elevated highs that the yields were at before this whole Silvergate / Silicon Valley Bank failure came into play.
Well, don't forget on Wednesday, the September Fed funds was at 5.6.
Right.
They had already pushed it to 5.6. I did not check to see how it ended up on Friday, but it wasn't 5.6. It had come down substantially from that level.
Yeah, the 2-year yield, the 2-year Treasury yield lost basically 50 basis points in 2 days. Incredible move.
Truly incredible moves. But even in the 30, which was sitting up closer to 4%, actually a little bit over 4% last Friday, not this one the week before. And so I'm thinking on this Friday, maybe it's 3.87, maybe 3.7, it's up 3 3/4. I don't know. But I don't see it as an instantaneous reaction. It's like, oh, the Fed's got to start releasing the money. It's like, no, they've already done too much of that. And for them to, so as a trader, I would look at that in the current market environment and think, no, what if they do only do 25 basis points, folks? I think that the smart money is going to like, oh, thank you. You're letting us out, and now we're selling.
So what if the Fed is so surprised that at its meeting later in March, we're coming up on that, right? We're almost lost half a March so far. Depending on what happens in the coming week, and I hate to boil this whole situation down to 1 week, but this coming week is going to be important in terms of revealing how much of an emergency the situation is, because people, again, like I said, are looking at Silicon Valley Bank's failure as not systemic, but there's a lot of implications from it. And in the least, you can say, wow, startup companies and innovation in this country is going to have trouble getting funded. And what is the economy and the financial markets without startup and innovation? And this is a particularly bad time to throw a roadblock in front of startup and innovation, partly because we need the economy to operate efficiently. It's usually technology that brings economies out of depressions. Not that we're in a depression, but let's say that prevents one from happening. The technology evolves so fast that it actually prevents one. This is particularly a bad time to lose funding for startups and innovation. It's going to have a lot of implications, to how the economy operates.
I agree very much. So I do think, and this is where we are in total agreement, folks, that I do feel that the Fed, the banking system, is in between a rock and a hard place. Because I think no matter what they do at this next meeting and this coming week, number one, is not going to solve the problem. And it may add to the problem. So I don't think there's a short-term fix at it. And so I think that my own personal opinion is that the Fed needs to continue on the path it has taken, simply because that's the one that will really smooth it out down the road, which is what we're heading towards. To have a hiccup in between where they got to take it back is not going to fix anything. And if they're going to make money available, which in essence they kind of do, because the federal deposit insurance, that's who's stepping in to take care of the deposits. Now, just to kind of think, it's not somebody who's like us, we put our money in the bank and the FDIC says, well, we'll guarantee you up to $250,000 if that's your account size. Your bank fails, well, here, You have insurance on that amount of money. Let me just toss in there, Roku's made a statement that said, well, they got $26 billion, $26 billion that they're now worried about not getting back. And they're wondering, how are we, like you mentioned, in our pre-discussion of all this, how are they going to pay their payroll? They have people. They are trying to move forward. They have new product. There's on and on and on. So now they've just reached this big thing where like, oh, how are we going to make our payroll? How are we going to do that? And trust me, folks, Roku is likely one of the smaller people that companies that have large amounts of money. You know, there's a lot of money sitting in Silicon Valley. And just like you mentioned as we came on, Dan, well, what about Apple? Did they have money with Silicon Valley? So we don't know. But what we do know, and now is coming out, that there are up to like 30 additional banks that have tie-in to this. And how's it going to affect them? So what is the avalanche rolling downhill? Is it going to pick up speed and really start to take out a whole lot more than what we're even looking at or what we could expect? And this is a part where I think that people believe it's isolated. And it may be isolated right now to Silvergate Capital and Silicon Valley Bank. But I think that the speed in which it rolled down that hill against Silicon Valley Bank, 48 hours, stunned me.
Yeah. So very reminiscent of Lehman Brothers. They had $12 billion in cash 2 days or 48 hours before they collapsed. And then the government had its own Lehman moment and decided that Lehman was the entity they were going to let collapse, and that really rattled the markets. So, you know, with companies, you know, I think Roku and Apple have so much cash they have enough to make payroll, but there's other smaller institutions who were counting on the money on deposit at Silicon Valley Bank to make payroll and do their operations. That's one thing the bank's for, is to hold some of their operating funds. So you've got a situation in which you have this kind of shock to the system, even though when you look at the banking system, it's stronger than it was coming into the 08. I'm going to call it 2007 to 9 crash, because it actually started in 07 with credit market problems.
Right.
And a busting of that carry trade that went on until it burst in 07 coming into 09, and even you know, the repercussions all the way into 11 and 12. So you've got a similar situation. We're just at the very beginning stages of it. And I hope what comes out of this is that people aren't thinking that this is a sky is falling doomsayer type prediction here, because what we're seeing are symptoms. The writing is in the wall. So you have a huge surge in treasury bond prices, and a drop in treasury yields Thursday and Friday. And at the same time, a huge surge in VIX, the volatility index, which is, people call it the fear gauge, but I wish I wouldn't call it that. It's much more than that. But the huge surge in VIX shows that people are getting nervous, and that the volatility suppression that's been underway, partly with the big picture cause that suppresses volatility, that's ended. So now you've got a spike in VIX. You've got a huge drop in treasury yields. I'm talking about Thursday and Friday, especially Friday.
Yeah.
You had a surge in gold. I think gold was up $37 an ounce Friday.
38.
And $38 an ounce, and the S&P 500 and various indices were down 1+%. So you've got that correlation that existed in 2022 where stocks, bonds, and metals all went down at the same time. And they shouldn't be that correlated, because they're not long term. There's usually a low to medium correlation between bonds and stocks, and a negative correlation, gold to stocks. So when you see Friday, stock market's plunging, treasury bond prices are surging in a flight to quality as everyone buys treasuries to hide. Gold is surging.
Yeah.
Now you've got the writing on the, and the VIX is surging, the volatility spike going on here. Now you've got the writing on the wall. So this isn't just I don't even think it's a prediction. It's actually observing what's going on right now, which are the way carry crashes start just like this. So they can be abated, or they can abate themselves if the situation is not as bad as it may get. But on the other hand, no one's going to wait around for that. You're going to hedge portfolios. You're going to take action to protect your portfolio and your cash. And so that is a hugely different attitude than risk on, where people are just buying stock and, speculating in GameStop up through the roof and back, all the speculation that went on, the gamma squeezes that went on. This is a hugely different environment where now it's like, I've got to protect my capital. And now I'm a little bit nervous about what's happening. If I can, how's my bank, by the way? And then they'll go look at the bank. Understandably, some institutions just want to diversify where their cash is. They may not want it in one spot. So you may get a seemingly innocent move of some of your money out of one bank into another. And if everyone does that, it looks like it is a bank run, but not necessarily targeting that bank. It's just, I really think I should have my funds as a company in different places so that I don't get caught with waking up one day and my bank shut down and I can't get my money.
Right. Now that's a great segue because what I want to kind of look at is that we also read, and we brought it to each other's attention today. Oh, wow. I'm just going to interrupt us. This is what just came across. The Newswire still produces, even though the markets are closed. And it says Silicon Valley Bank paid out bonuses ahead of FDIC seizure. So
how far ahead of it?
That part I didn't. Well, let me just see. I don't know. I don't know if it's going to say that.
Insane.
No, it's just a headline. We have to go. Axios has got the story, so we'll read it later. But as all of this starts to come out, it's going to be amazing. And so if that doesn't throw a negative pull, if it's true, and they're like, hey, we're going to get shut down here, so here's your money. You guys can all have it. And because we're all going to lose our jobs. If the FDIC does not go, no, you need to bring that back. You can't do that. And they take it all back. I don't know. But in any case, it made me lose my train of thought, and I apologize. So I think that what I really want to kind of talk about now is some of the fallout that we're seeing. Again, now we're seeing it in like Binance and Coinbase. Coinbase being the largest crypto exchange in the United States. And there was a mad dash to convert into stablecoin, to the point where Binance and Coinbase said, we're not going to do that anymore. Those are all temporarily on hold. I would like to just get your reaction to what you think about that.
So you've got a stable coin that's convertible to the dollar, right? And now they're suspending it. We just saw that headline today. Again, we're in the fog of war, so we're still seeing the effects of not only Silicon Valley Bank, but the crypto industry collapse. So now it's not convertible into dollars anymore. So not much of a stable coin if that happens. It's tantamount. It's tantamount to the money market funds that were breaking the buck in the 2008 crash. The money market fund is supposed to hold its value at $1 per share because it's a money market fund, and they almost always do, except when there's a crisis, like the crash of 08.
Right.
And
let me just add what they said. I tried to interrupt you. Is that you're right, and that it's supposed to hold $1. $1's worth $1, right? Well, it traded, I believe, before they actually pulled the plug on it, 87 cents.
Yeah, I heard that. So, stable coin, but nonetheless, another symptom of not just the evaporation of liquidity from a financial asset class, like crypto and the products that came out of that industry. Mm-hmm. And not just another, symptom of pulling liquidity, but it's the possible canary in the coal mine. So in other words, we would all like to think that what's happening in the crypto industry is limited to the crypto industry. Right. But I contend in my report again, and I've been saying this for some time, and the report that I'm working on the carry crash and what's going on with this whole thing right now, I'm contending that there's a lot more happening than just the crypto industry.
Yeah.
So in other words, crypto industry, Silicon Valley Bank, those are all symptoms of the bursting of the carry trade, the latest carry trade bubble. And I say the latest because this keeps happening over and over and over. Has anyone wondered why we keep seeing more and more frequent market crashes, stock market crashes, even though we have a Fed that was incepted partly to keep things like that from happening, to keep the dollar stable, the economy stable, to manage interest rates, to manage the central bank functions of our country. It's not working. We're having more frequent crashes. We went from 1929 crash to 1987 before we had to deal with another crash, 1987. Then they started to happen more and more frequently. And they still are. So now we just had one in 07 to 09. We had what could be called a mini crash in 2015. Then we had the COVID crash in 2020. That was only 11, 12 years later. Right. And now we're talking about another potential one now. Now it's only 3 years after the COVID crash.
Right.
Why? Because the government and the Fed did the same thing after the COVID crash, and during it actually, as they've done every other crash. Let's inject trillions or tons of money into the system. Let's drop interest rates to zero. Let's bail out the institutions in trouble from the carry crash that was happening during the COVID crash. Let's bail them out. Let's give them money. Drove the stock market into another bubble, and now it's collapsing again.
Right.
So the very mechanism the Fed uses to prop up the economy and the financial markets when they crash is laying the seeds for the next crash, even as they execute their monetary policy, their emergency provisions for dealing with the crash in the first place.
Right.
So the roots of the next carry crash are always, I should say, the seeds are always sown during the crash that you're in, and the Fed is injecting money into the system. It's a sad, it's like Groundhog Day, we're going to wake up again and it's happening again, and it's going to keep happening until we revise this financial system. Yeah. And I get kind of passionate about that because the financial system is rife with problems and it needs to be revamped. I'd love to have a voice in that.
Yeah.
It needs to not create inequality throughout the country and the world as it does, despite everyone's desire to have equity and not have inequality. It's just the very Fed policy is contributing to inequality enough that it's on the Fed's agenda. And I think Congress has asked about it. It's like, can you look into your policies and see if they're contributing to inequality? Well, they are. So now we get another potential crash. And if we're wrong about this being one starting up now or soon, it'll still happen if we're under this regime, this carry trade regime, this Fed going into the markets like they're the wizard behind the curtain, thinking they can tweak the economy and prevent recessions from happening and keep employment low and keep the dollar stable and keep interest rates stable and manage the country's financial functions like a central bank does.
Yeah.
They think they can do all that, but they can't. They can't tweak it, and they're always, it seems, a day late and a dollar short, like the interest rate increases they're doing to combat the inflation they caused. Yeah. They're a day late and a dollar short, so they're caught raising rates at a time when we have another financial crisis emerging.
I agree. And when you
let's do another podcast. Let's do another podcast, and I'll tell you how I really feel.
It truly is another podcast, and it's very important to have the conversation. What I wanted to talk, as soon as you mentioned the wizard behind the curtain, I don't think there's going to be anybody that listens to us or even has in the past and now looking to listen now that has not seen the Wizard of Oz. So that's the wizard behind the curtain. Now, picture in your mind, folks, what was that wizard doing? Pulling this lever, pulling that lever, pressing out the smoke, blowing the flames. Why? To distract you. To distract you from the reality of he can't do anything. He's not really a wizard. He's just behind the curtain. Now we're taking a step behind the curtain because everybody's looking toward the Fed to come up with a solution that's going to smooth all of this out. And if we really look at it and we honestly tell ourselves, well, what can they do? The only thing they're going to be able to do is provide liquidity. And how are they going to do that? Well, yeah, they could lower interest rates. Or the FDIC goes in and says, we'll bail you out. No matter what it is, it's like providing liquidity, providing additional, what I'm going to call stimulus. But it's not stimulus that goes to our benefit. It's not like they're giving us a check that we can go out and have a good time with, but it's still adding liquidity to the monetary system in order to save the monetary system. So I think that as they all meet behind closed doors now, trying to decide what are we going to do and how we're going to do it, I want listeners, traders, everybody to really get an understanding. This is a serious situation. It's a serious situation that's unfolding, but it's been in the making for several years. And Dan is now putting that all together in a report that I think, because of the length that we have to contain things and just how much we can say, maybe just scratching, just putting a nice little deep scratch in the surface so we can start to take a look behind, or starting to pull that curtain back a little bit so that we can see behind the curtain what really, really is going on. So I think that just to have I find that many traders now, they have this mindset. It's like, I'm not going to get excited about it because the Fed will bail them out. You know, the Fed will ease the rate. The Fed will do this. It's like, no, don't count on that. That may be the way that it has been for the last 13 years, to fill in that number for you. The last 13 years, interest rates have been basically close, if not at zero. So we'll give you free money. You go put it to good use. They have. It's time to pay the piper, as you talk about so often, I talk about. And I think that is actually what is now starting. Now, whether we see in the meantime, valid of what you're saying, the 30-year bond, folks, was up over 3 points on Friday alone. Now, this was a move that I had talked about, but again, as I've said in my own analysis and my own updates, I can't tell you what the situation is going to look like, because I was looking for the stock market or the equity markets to go down and the bond prices to go up. And the way that people associate that is, oh, lower rates. That's good for the market. Let's buy the market. It's like, no, it's not. Here's the situation, folks. It is a run to safety, and a valid run to safety, but it may may not work, because the next move that I see coming for interest rates is a very, very large decline in bond prices, rise in bond yield. So I do see interest rates really going up. So I do think, even though they may try to ease our minds and ease the market and stick to a 25 basis point instead of 50 or even more, in my own mind, I'm like, folks, don't fall for it. We will, as day traders, oh, you bet I'll buy it. You bet I'll go in there and I'm going to trade exactly what the price action tells me to do. But I'm not going to walk away thinking like I'm going to buy Apple, Amazon, and do all these stocks and buying all these long calls because we're going to new highs. That, in my opinion, is not going to happen. Not going to happen at all. We are in a very serious situation, and I think our country and the globe is in a very serious spot. And Fed doing 25 basis points versus more is not going to erase, it's and not even going to put a Band-Aid over the problems that are existing.
And this is one reason the Fed puts itself in untenable positions, because it's, I'm going to say, always a day late and a dollar short. I probably shouldn't use the word always. Maybe they're not always, but I think this whole thing isn't always a problem. This whole Fed policy regime is a problem. So right now they're sitting here raising rates to combat the inflation they helped cause, and which is also going on in other countries. They're raising rates at a time that the bubble is that was created by the whole Kerry regime in the first place is bursting again, and they're caught late to the game. So the fact that they're raising rates, which they're now, not just now, but they have been the last several months locked into, because if they change their minds, they're going to lose credibility. And if they change their minds for reasons that aren't due to their credibility or lack thereof, then there's another reason, like an economic emergency, and that's going to unnerve people also. So the point is, people are now going to look to the Fed to help out. Again, that's been since after the 87 crash. The seeding zone for the next carry crash sometime in the future, even while they're trying to deal with one now, or one potential one now.
Yeah.
So soon we'll know the answer to this, because if I'm wrong that we may be seeing the signs that it's starting again now, a crash in the, or a collapse, I should say, in the stock market, or whatever the word is you want to use. Even if I'm wrong about that, it'll still happen, because this whole situation has to be unwound. The whole world acquired free money, whoever had access to it, that is. Institutions required free money for years.
Right.
And invested it somewhere. That whole regime is being busted up. And Silicon Valley Bank is a perfect example, because they were putting a lot of their deposit money in treasuries during 2022, at a time when rates were rising, bond prices were falling, causing losses in their investment portfolio, causing the problem that we're seeing now.
Right.
So that's a perfect symptom, and this may be going on in many institutions. It could be going on in some hedge funds, it could be going on in some other banks, some sovereign funds. You don't know the extent of this, and hopefully it's not as horrible of a shock as it seems like it could be.
Right.
I mean, maybe there's something I'm seeing that makes it not quite as bad as it seems like it could be. But on the other hand, this doesn't seem like the kind of thing that's just going to blow over this week, even if there's a short-term solution, or if all these companies say, don't worry, I made my payroll, no problem. It's still not something that blows over fast, because the financial system failed, as exhibited by the crash of 07 to 08. It was band-aided back together through Fed quantitative easing, through Dodd-Frank, through regulations upon regulations, band-aided back together, but not revamped enough to prevent this from happening again. And that's what we're looking at now.
Right.
The system wasn't revamped. It's the same system with band-aids on it, and it's the same thing happening again.
Yes. And folks, I hope you stick with us, because I really have been trying to time it. So Jan and I realize that we can talk, and we can talk for hours, and that may not be the best way to go. But I do want to finish up, because I'm going to bring Elliot into this. I'm going to bring a little bit of Elliot Wave and talk about my long-term count. And my long-term count is that, again, we're in a larger super cycle degree fourth wave correction. And so with the market in at least the S&P, what it's correcting is from 1932 to 2022. So it's really correcting 90 years of which, in effect, was a bull market, which contained all of the crashes, including the Big E in 29, all of the recessions, everything that World War I and World War II, plus the Vietnam, plus. But where we are within all of that is, I think we're either coming into a low, which might only be on a primary degree A wave. Maybe if I had to switch degrees around, it could be a cycle degree A, but I doubt it. So even if I say it's just on a primary degree A wave down, then we're in for a primary B wave rally. So you're talking about that they kind of can fit in, that we get this momentary little bit of a respite over interest rates being hiked to allow time for whatever to settle out, to make adjustments, to do it as necessary. But if you're a long-term trader, you don't want to fall for the game. Don't fall for that. Oh, everything's perfect, everything's great. Look, we're rallying again. Have a little bit of understanding of what actually is behind the curtain, and what is and which I think we should say for another podcast, just looking at the characteristics and the personalities of a B wave. What can we expect during that period, and why that is realistic in terms of what we need to trade during that period, but unrealistic in terms of what it really tells us about the long term, the long term.
Yeah, I think that's tantamount to the situation from the 1929 to 32 collapse in stock prices, let alone the economy. But with respect to, there was a crash of 29, people jumping out of windows, the infamous crash of 1929. But then from the low, which I believe was November 1929, into the following April of 1930, the market rallied in a B wave, like you were just saying, meaning a counter trend rally. And during that time, and I've read about this. I wasn't alive at the time, but I read about this. How people were going, "Oh, good, that's over with." You know, the crash of 29, it's over with. Everything's okay now. And the market, I think, it retraced 50% of the crash. That's how high a B wave or a counter trend rally can go. And then you had just the unleashing of a horrible decline. You know, 1930 to 32, when the market lost the rest of something like 90% of its value. And I mean, hopefully that doesn't happen now. I think the point is, you were saying, you know, basically beware of the next B wave. It goes up, everything seems okay, but it's a B wave, a counter trend rally that could yield to more new lows later.
Yes, that is what I'm alluding to. But at the same time, what I'm also saying is pretty much what you're saying. That, and if I put it even in my bigger picture, if it's only a primary B and then a primary C, that's just finishing cycle A. We get to do it all over again. We have another cycle B wave. And so, because remember, when we're talking about a lot of it, and we have a lot of economists that are talking about what's going to happen, they're talking about 2024, 2025. We're having trouble just kind of getting to March of 2023, let alone trying to put a forecast together. Like, what do we think is going to happen 2 years from now? But if I take a look at my bigger picture, that big of a picture, it might not be a bad time to take advantage of each one of these B waves and just getting yourself a little bit more prepared, particularly people that, you know, that are moving larger sums of money and trying to protect larger sums of money. I'm going to kind of end it there. I'm going to go, you can go ahead and respond, but I don't want to go too far because we now have gone over our 1 hour limit. I'm really going to try to keep it. What it does mean, folks, is that Dan and I will be back again, and we will continue this type of a conversation coupled with other things that we think we need to bring to folks. Closing remarks, my friend.
Well, it's good to leave it on a note of large sums of money. So that's a good way to end it. But yeah, I think as I think in my mind about this discussion we've had, and trying to make sure it's understandable by people who may not be in the industry, like you and I have been doing this for decades.
Yeah.
So, and we can talk in industry jargon, and these things are secondhand to us, you know. So, so as I think about this, I hope that this complex subject of what's, you know, behind these repeated and increasingly more frequent crashes in the equity market and financial shocks is the carry trade, which again is borrow cheap, invest in something that's going to give returns. This is done by institutions. The everyday person can't go to the Fed window and get free money.
No.
So the Fed disseminates its policy partly by making that money available to institutions, and they invested in the stock market for years globally.
Right.
And the difference between the cost of money and the returns is the carry. When the cost of money does what it just did now, this year, and last year, where rates are not zero, they're more like 5% on the short end of the curve, close to it. And then the investments, the stock market in this case, have been declining in value. You've got a whole different situation. So I think the takeaway from this complex subject is that understanding that is what's bursting right now in the globe, and that goes well beyond. That's much bigger than Silicon Valley Bank,
yes,
or even a systemic banking system problem, which I'm not saying there is, but if it were limited to the banking system, that actually could be good. But this is the whole financial system that's vulnerable here, because everyone's been geared to this type of situation with low interest rates, investments, whatever, for years now. And now we have the opposite. We have higher interest rates. We have inflation that's not under control. And we have now a potential urgent situation, to use a nice phrase, with the situation with the Silicon Valley Bank and people probably now wanting to more protect their money. And Michael, this is on, I won't keep going because I know we got to end this, but this is in addition to the things we've talked about on recent podcasts.
Right.
So the fact that the global economy is now deglobalizing,
Right.
Deglobalization, onshoring foreign manufacturing back on shore, that takes years to do, and we have a war, in Ukraine, and a Cold War type environment. This is all in addition to what we've talked about in recent podcasts. So I think the moral of the story is the whole financial system is going to be under a lot of scrutiny. And this coming week, especially, there's going to be a lot of people looking to see how bad this is going to get. And we'll know by how the markets react as we go forward.
I am in total agreement with everything you just said. In fact, I'm going to add that, folks, you're not going to want to miss, and I'm not just blowing smoke here, you're not going to want to miss the publication on defendingyourmoney.com on Dan's report. It's not vital for an investor, but it is. And I say that because grasping the situation is going to take time. It's a very complex situation, and it's unfolding in a very complex way because bits and pieces start to make itself known. It's kind of like you see a plane crash, you see the smoke, you read the devastation, but then as they piece it together and they pull all their information, you get to see what caused it, why it happened. And sometimes that investigation could take 1 or 2 years or more. So again, just kind of making that analogy, here we are in the beginning stages. And you guys, if you're following my work, you hear me say, we're in the beginning stages, the infancy of a longer term decline. None of this what's happened, this buildup that Dan has so very eloquently laid out for us on what got us here and how the buildup of the carry trade and the continuation of the carry trade and now the decline of the carry trade. Mark our words, folks, this decline or the breakup of the carry trade, it's just starting. It may be has been underfoot for a year, okay, but it's really just taken hold. And now we're beginning to see how that is occurring. So again, and I don't think neither Dan or myself are trying to put out anything that's going to like scare people, alarm people. No, but I am a great believer in that if you're approaching the market because of fear, then the only way that you're going to get out of the fear is to educate yourself, is to have an understanding of what really is happening. You're still going to want to invest. You're still going to want to do things, but it depends on where you're going to want to put your money. And that, my friend, or friends, is where you're going to want to turn to, and I'm going to say it, defendingyourmoney.com. That's Dan's website. That's where the reports get published. That's where his work can be found. And that's where you're going to get that look behind the curtain. What's really going on? How long has it been coming up? So again, when we were talking about other podcasts that we've done, particularly on gold, we were talking about reports that really dealt with gold in a deflationary economy. What happens to it? But more importantly, what we were talking about is that this concept that gold has no return is very misguided, because you can get a return from gold. And Dan can show you how. And so there are a lot of things that can be done. And what we're trying to do, again, get behind the curtain, show some truth to the situation. Because what we hear, again, on MSNBC or NBC or Fox News or Bloomberg or CNBC, they're not doing anything that they're just trying to be misleading or whatever. Although I will say that poor Jim Cramer did, just before a while, like maybe a week before Silicon Valley Bank went under, hey, no, there's no problem. There's nothing there. It's still a good investment. And I want to remind people that the day before, or two or 3 days before Bear Stearns closed their doors back in 2009, he did the same thing. So choose who you want to listen to. And that's where I'm going to end it. I'm going to say thank you so much, Dan. And our conversations will obviously continue, but we're going to finish this one right here. And I'll catch you on the flip side. Thank you, everybody, for joining us today. Thank you for sticking out or hanging out with us for this more than an hour, because we have more to tell. To the next time, have a good evening.
Thank you, Michael. See you later.